I dare say it's the most severe event that the world has seen, but we're going to wake up one morning and all of a sudden the market's going to be up 20%.
If you play a rough market, it's literally how you add a zero to your net worth.
10 years ago, we used to talk about billions the way we're talking about trillions of US dollars today.
Data points that are going to start rolling in are going to be horrendous. The entire world to a sudden stop.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
All right, what's up, guys? My name is Jay Martin, and I'm the CEO of Cambridge House International. And if you are a subscriber, then you likely know what we do is produce investment conferences all over the world where we help investors make money in the equity markets. Now, today is March 26th, 2020. We're going through more volatility and uncertainty in the markets than we ever have before and potentially ever will again. And so what I'm doing right now is leaning harder than ever on my network of keynote speakers, money managers, company CEOs, in order to get as much perspective as possible and help position myself. The best thing we can do is gather as many ideas and opinions as possible and then apply the strategy that makes sense for us. So I wanted to share a bunch of these conversations with you. So today, I'm going to share a conversation that I had with Ross Beaty, the chairman of Equinox Gold and Pan American Silver. We discussed his outlook, short-term and long-term, on copper, gold, and silver. I connected with Grant Williams, the founder of Real Vision TV and the editor of the newsletter Things That Make You Go, Now, I like Grant because he's got a global outlook in this macro perspective that helps me as a small cap equities investor. I connected with Marin, Katusa, hedge fund manager and founder of Katusa Research. Now, look, I'm super fortunate that I get to connect because of my conference business with so many high profile investors. But right now, there's nobody that I'm paying more attention to than Marin. Crisis investing is what Marin is best at. So I put him on the spot and asked him how he's positioning his fund, the deals he's doing, and how he's allocating capital. I also connected with Randy Smallwood, the CEO of Wheaton Precious Metals, because probably like a lot of you, I believe this very unfortunate crisis will eventually be the setup for a very lucrative precious metals market. And even today, I want to make sure that I'm positioning myself accordingly. And I believe that's going to start with some conservative bets placed on companies with fixed costs, ideally that pay a dividend. And Wheaton Precious Metals ticks all those boxes. Randy Smallwood is a battle-tested CEO. So I hope you guys enjoy this. If you did, please comment on who you want to hear from next. So I found myself watching a lot of the Vancouver Resource Investment Conference content. You opened up that show. It was a Q&A with Marin Katusa. It was a jammed hall. And one of your statements was, 2020, the major markets are set for a major correction.
I believe that the major markets are set for a correction. They've been going now for over 10 years, 11 years now. Markets don't go up forever. When nobody expects things, things change. And I'm kind of going to say that might happen this year. And if that changes, it'll have negative prospects for many economies. It'll have negative prospects for the American economy, European economy, and so on. So markets run in cycles. So it didn't seem to me the least bit clever to predict that we were going to have a major correction. Corrections happen. I've lived through many, many corrections in my 45 years in the kind of business. And you know, it seems like a long time, and it kind of is, but if there's one thing it's taught me, it's when markets are really buoyant, that's probably a good time to lighten up and sell. And when markets are really busted and when there's blood in the street and everybody's fearful, great time to buy. So January, you know, I didn't know, you can't predict the future that well. I mean, I didn't know when it was going to happen, what the severity was going to be, what the cause was going to be, how long it would last, and I still don't. I mean, this has come out of the blue, this COVID thing, and it turns out to be a cataclysmic event. And the speed at which it's unfolded is unprecedented. The volatility it's created is unprecedented in my lifetime, not just the last 40, 45 years, in my lifetime. And I dare say it's the most severe event that the world has seen collectively as a world. It's since the Second World War, which is a cataclysm. We haven't seen a major war. We haven't seen a major pestilence. We haven't seen any kind of thing. There's been a lot of noise, a lot of little skirmishes, but there's been no global, synchronized, profound down event like a pandemic. It's epic. So it's happened. It's behind us now. I mean, the impact's happening to every single person's portfolio and every single, quite frankly, almost everybody's lives in the whole world. I mean, I work, between Pan American and Equinox and my renewable energy company, Intergex, we have operations in a total of 11 different countries. And it's pretty much the same story in almost every one of those countries. People are locked down. They're in their homes. They're not consuming. They're not going out. They're just hunkering down, getting through this thing in the right way, as per every single doctor. Just keep away from people. Live in a box. Live in an isolated box for a while, and it will get better. That's the solution. It will get better. We know it'll get better. We have an example right in front of us, China. So we know exactly what to do. We're doing it by and large. There's a few exceptions. I have to say, I think the United States is an exception. There's a few others in the world. And when it hits those places, it's going to be really bad. But if we do things right, I have optimism. I'm an optimistic person. I have optimism that the West will eventually end up like China is now, like a month later or even 2 months into this thing, and things are going to be better. This is the time when everybody's sort of in crisis mode. This is when you want to be courageous and you want to step in. And you don't want to step in all in right now, because this thing may go another couple of months. We really don't know. I don't think it's going to go longer than that. I think there's multiple things that me as an optimist would say are going to beat this virus. We're going to do the social distancing correctly, and that's going to slow down. It's going to flatten the curve. It's going to create less crisis. Some places like China are already coming back. That's bringing back some demand. You potentially have some fast-track virus vaccines, or potentially some other types of therapy for the really badly affected people, so that it won't have the same mortality as it might otherwise have had. Maybe summer will hurt it. Maybe this virus will be affected by heat. Who knows? So all those things, they could cause this to be kind of unwinding in maybe a month or so. Maybe I'm wrong, but that's what the optimism in me says. So I'm going to say this thing will last, in terms of the market meltdown, maybe another month or so. And before it ends, there's going to be a lot of the smart money in the world is going to go back into the market to try to pick up the lows. Right. So this is like a U. We've had the crash. Now we're bumping along the bottom, and it could go lower. Sure, of course, it could go higher. It's going to be lots of volatility. But we're going to wake up one morning, and all of a sudden, the market's going to be up 20%, the broad market. And that's because the government is flooding. All governments all over the world are absolutely flooding the world with liquidity and easy. Interest rates, zero, negative. People can borrow and basically get paid to borrow. It's crazy. This will cause a wave of stimulation, which will affect most metals. It won't touch oil, unfortunately. Oil's got some very, very profound problems, but it's going to be pretty good for copper, nickel, zinc, those metals. And I think it'll be extraordinarily good for gold and silver. I think this is setting up to create an absolute epic run in gold and silver, like maybe we haven't seen in many, many years.
And then I wanted to touch on your comments about copper there, because
I like copper. Copper's a very good metal to hold for the long term. So I define investment horizons short, medium, and long term. And copper's, I think it's good short and medium and long term.
I know you're bullish on copper, or at least were in January, and probably still are long term.
I still am long term.
And a lot of that bull sentiment, I believe, is driven from the evolution of the electric vehicles, like the growth of the electric vehicle movement. But how is that outlook tempered now? Is it tempered for the short term?
Yeah, of course it's tempered. Of course. You've had immense demand erosion. Whenever demand completely collapses for anything, the price goes down. You have had offsetting that to some degree, you're having supply erosion now where mines are closing, and that's decreasing supply. You have a metal price that's so low right now that nobody's doing exploration. All expansions are on hold. That's going to ultimately trickle down to have a positive effect on the price. but really we need demand to pick up again. The solution there is going to be the stimulus that's coming in to push people getting back to work, and that's going to create jobs in infrastructure and things the government can do. They can't tell people to go and buy more iPhones, but they can certainly say, we don't care about iPhones. You're going to work building this highway or that railway or whatever, and that's going to put a lot of people back to work, and it's going to create a lot more consumption of these things. So the same way it did from 2009 to 2011. It won't be the same speed at which that correction happened, but it should certainly get copper prices back up until the fundamentals for copper kind of reassert themselves, and they're very good. The fundamentals for copper are very good because it's essentially its growth is in not just electric cars, but in everything electrical. As we move as a world away from fossil fuel-based electricity to clean energy, all of those things use more copper, and that's very good long-term for copper. But it certainly has taken a hammering, and whether the right investment today is a copper company or a gold company, quite frankly, I'd put some money in each. If you've got any cash at all, I'd buy a little bit of each, because the gold companies haven't been pounded nearly as badly as the copper companies.
Yeah, right. I mean, right now it seems like the only asset class that's doing okay is the US dollar. Everything that has a bid is getting sold, and it's this massive flight to USD. And yeah, eventually that cash has to be redistributed, right? And probably, would you agree to maybe conservative bets first, or what do you think will be the first benefactor?
Well, when people stop selling everything, and maybe that's already happened, we've kind of, as I say, I think we're kind of at the bottom of the U. They put their money in safe places. They stick it in the US dollar. That's been the flight to safety, and it always has been. But I think when the sentiment changes that we're not going to go any further down, and they're going to say, okay, I'm going to take some of that cash, which creates no return, put it back into equities that do create a return. And then if they think, and they realize the trillions and trillions and trillions of dollars of stimulus that is being poured into the market by every government under the sun, that simply demeans the value of paper money. It's just an inflationary kind of a thing, or a devaluation of every currency simultaneously. That just is a great fact pattern for higher gold prices. Because I am super confident in a secular bull market today in gold, but we've got a lot further to go, and I'm just super confident the gold is going to have a great year this year.
But you're not done.
So that's where gold, as an alternative investment product, as an alternative form of money, is a good place for people to be with some of their money. I'm not saying put all your money into gold, although it's probably going to give you pretty good returns if you do. Maybe less risky, but it should be something that some people do. And if you realize the trillions of dollars that are sloshing around the world right now in US dollars, and the more trillions, or the additional trillions that are coming in from all the easing, if you just take a tiny, tiny, tiny bit of that money, 1%, 0.5%, and have that buy gold instead of all the other stuff that it could otherwise buy, that's a massive, massive demand for gold, and that's going to cause the gold price to go up. Just a tiny fraction of the money that people have out there sitting around moving into gold because they think, you know what, paper money is being devalued. Gold will never devalue. It has inherent tangible value. It's always been a store of value. That's going to cause the gold price to go up, and as it should.
I was honestly, Ross, a little bit surprised that the gold price got hammered through this, because you know, I've always seen it react positively in times of crisis. However, this is the biggest crisis I've ever seen in my life. And it showed me maybe that when people are really scared, like fighting in the streets over toilet paper scared potential, they go to the currency that everybody recognizes.
You know, it had nothing, the move of gold, the gold went down 10%. You know, everything else has been 30 to 50% down in the last couple of weeks. Gold's down 10%. It's got anything to do with the flight, or the lack of a flight to safety, or a flight to gold as a store of value. It's all got to do with forced selling. It's when people buy on margin and they get a margin call, the guy who's provided them the money against which he has collateral, he just sells the collateral. It doesn't matter what it is. If somebody's hard up for cash because they've got to meet obligations, they sell everything they can. And so some people had to sell their gold, and they just hit the bid. It's highly liquid. It's an international market, open 24 hours a day. It's a very easy thing for people to sell. That's when gold is delivering what it's always delivered, which is as a store of value. It is always a market you can buy and you can sell. So gold certainly served its function there. And gold did exactly the same thing in 2008, 2009. Exactly the same thing. It went down about 10%, 15%. With everything else, when there was this huge fear, everybody sold everything they could. Everybody who had debt sold everything they could, and they had in order to pay back required debt repayments. And then at some point in the financial crisis that happened 2 or 3 months into the crisis, I think, when gold dropped down 10 or 15%, and then of course it had this glorious run that it performed absolutely everything for the next 6 or 7 years. From 2009 to 2009 to 2013 or 12.
Yeah.
Then it slid, and then it's bumped up again. So it was a great investment in those years.
Now I want to thank Ross for letting me share that conversation with you guys. Ross is self-isolating in his home on Bowen Island. We're going to move over to the Cayman Islands with Grant Williams, the founder of Real Vision TV. I think a lot of us, we could have called the bull market was going to end soon, right? It seemed like every day this thing ran forward. We were probably closer to the end. And such a profitable bull market for 11 years, we, maybe knew the ending was going to be spectacular. But obviously nobody can predict how or when. And the match that set this event, being COVID-19, has now become a global cataclysmic crisis, and one that I've heard compared several times in the last week and a half to World War II, being the last significant event that hit the entire world and enveloped the entire planet in a crisis like this. And do you think that's a dramatic comment to make, over dramatic, or is that kind of on the money?
Well, there's a couple of things there, Jay. I think the first thing you said is very important for people to understand, is that this virus, this pandemic, is a catalyst. It's not the event itself. This is a catalyst for the unwinding of years of debt accumulation, leverage buildup, of overvaluation. This was going to happen at some point and in some way at some time. And there's been a lot of people, myself included, who've been marveling at how long this game has managed to go on for, as things just got more and more expensive, and central banks did the kind of things that have juiced every asset in the world higher. And now we're starting to see A, what happens when bubbles burst, again, as if we need a reminding after 2008, and B, and more importantly perhaps, is just how powerless the central banks really are in truth. When something meaningful happens, cutting interest rates, announcing $4 trillion of stimulus, that the market fell 12%. So it didn't make any difference at all. We've got a rally now, which people will equate to the announcement of a bailout package to the tune of $2 trillion from Congress. But the reality is the market was so horrendously oversold that this bounce was likely to happen anyway, and is to anyone that's traded markets through periods like this before, perfectly understandable and predictable. What happens now is going to be very, very important, and I would suggest that we're going to start to see data points roll in. You're already starting to see some of the estimates for second quarter GDP in the US. They started at minus 14%, which was extraordinary. Then Goldman came out with minus 24%, which is unthinkable. And then I think Morgan Stanley said they thought it was going to be minus 30%, which is unfathomable. And so these numbers, throw in the initial claims, which I think are out either this afternoon or tomorrow, I'm not sure, I forget, tomorrow I think. Goldman Sachs again said that these numbers could be 2.25 million initial jobless claims. And if you look at that on a chart, it's preposterous. I mean, it is utterly preposterous. Another bank is out saying it could be 4 million. So we really don't know, but the data points that are going to start rolling in are going to be horrendous. So I don't feel as though the market has discounted those kind of numbers. The Germans are, for the first time, going to go and use the printing press to bail out the German economy. And I was reading a piece this morning, I think I'll put it on my screen still, talking about 750 billion debt financing to counter what Merkel called the biggest challenge to Germany since World War II. Now, if you think about that, if you think about what a severe event this is, and you realize that the market has fallen far less than it did in '08 already, it tells you that this bounce doesn't really have much chance of holding, I don't think. We have the entire world going into a sudden stop. And that is going to be catastrophic for business, for economies, and it is going to require the printing of trillions and trillions of dollars and bailouts left and right. And we've brought this upon ourselves. And if you think that down 25% or wherever we are now, which is much less than that, we've rallied obviously. If you think that's enough to wash this out, you're out of your mind. You're absolutely out of your mind. So I think we've changed from a buy the dip environment to a sell the rallies environment. And I think as the data starts coming through and we realize just how big a shock this has been to the global economy, to business, to unemployment, the reality of the situation and just how expensive a lot of these things still are is going to feed through. And it's going to reinforce the amount of money that the Fed decides to print in order to try and stave this off. And so we're in this loop now that is going to, I think, keep spiraling until we find a bottom. And the bottom is going to be found when things are worth buying and worth holding for the long term. I've spoken before about the difference between being an investor and a trader. I think every trader was looking for this bounce, and I think every smart investor is staying the hell away from it. And that's the difference between the two.
Right. Now, I mean, it's a question that gets asked probably too often, but we're at the early stages, like probably the first inning of what this event will become. And it seems like the Fed is swinging for the fences already. Eventually the power has to run out. Like how long can that strategy, that stimulus strategy actually go on for?
Well, look, I mean, you mentioned World War II. Of course, the difference between this and World War II is here industry has stopped. In World War II, industry was repurposed to the war effort, and everybody could get behind this because there was a visible enemy. The Axis was very visible, so people knew who and what they were fighting against. Here, it's an unseen virus that has people actually pulling apart instead of uniting because everyone's suspicious that they might catch this from the guy that they're talking to in the street. So it's very, very different from that perspective. Yes, the World War II had a global, it brought about a global cohesion that we probably haven't seen since, in fairness. But if you were at home, if you were in the United States during World War II, apart from the inhabitants of Hawaii, in December 1941, it didn't really affect you. You were there, you kept reading about the news. Yes, people went off to war and didn't come back, but life kind of went on. Here, life has shut down. People, from Sydney to Nova Scotia are indoors, not knowing what to do. And that's going to change. I spoke about this to someone else this week, just talking about how we are going to have the pre-virus and the post-virus world. And I genuinely believe this is going to change the way society behaves. I think you're going to see next winter when the flu season comes around, this will pass, which is the good news. And we will go on. People compare it to Spanish flu, which is horrendous, but we're still here and we will still be here after this. But the next flu season comes around and the first recorded case of COVID-19 or COVID-20, whatever it is by then, I don't know. That's inflation for you. Once that gets announced, people will self-isolate. People will withdraw. They will stop going out. They will stop spending money. So we're going to have this until there's a cure, a vaccine, or something for this thing. It's going to be a recurring nightmare. And generally, these things, when they come back, are more powerful the second time around. So whether you believe it's an overreaction or whether you believe it's a deadly problem is really to miss the point. We're dealing with it the way we are. It's changed everything. It's a problem for the global economy at the worst time. And so that's what we have to deal with. And for people looking at stock prices and thinking, oh, is it time to buy yet? The answer is yes, only if you're very nimble, you're ready to take a very sharp loss, and you know that you're going to rent this and not own it.
Got it. Right. Okay. Now there's a whole bunch in there. One thing I wanted to touch on, in terms of that market timing, you're looking for an entry point into the market, and I would never ask you to call the bottom, Grant, but what would there be some indicators that you're going to be looking for, or some events that you're going to be looking for to give you a hint that we're near the end of the sell-off?
Well, look, I think you have to look. It depends. For me, I'm an investor. I'm a value investor, so I look for value, and you're starting to see value occur in places here and there, but because things have been just smashed. But if you're going to buy value, you have to buy it in times where you don't risk losing half your investment. So I don't think we're anywhere near the bottom yet. I think we've got a long way to go before we bottom in these markets. And so I've been defensive. I remain defensive. I totally understand why people are being tactical, and I've made some great calls on this bounce. I also know a lot of guys who made that call that are selling today because they feel like a quick 15-16% is plenty for a bounce. And if you look back at 08, you'll see we had some extraordinary rallies amidst that decline, but the market didn't bottom until it was really sold out, and we're just not there yet. We're just not there yet. And this bubble is not housing. This bubble is everything. It is equities. It's bonds. It's everywhere. Funny enough, except gold. And I think that's why you're starting to see some life in the gold price, which I think is going to continue. Is going to continue to strengthen through this.
Yeah, and your comment there about you're a value investor, right? You're not looking to catch a quick turnaround. How important is it to understand that, like what kind of investor you are, if you are a trader?
It's such a great question. And I think personally, again, I've spoken about this week, I think that's the most important question to answer. If you're sitting in the middle of this stuff, you need to understand who you are and what you want to get out of this. If you're a trader, this is heaven, right? If you are a hardcore trader, this is the kind of markets you dream for, because you've got real moves that if you back yourself and you're any good, you can make some great money out of. Most people aren't that. And the people that think they are but aren't sure, let me tell you now, you're not. If you don't know, that's not you. And so, I think understanding who you are and what you want out of this is the first and most important question to answer. Because if you want to put money into the market that you can worry about less, I was going to say that you don't have to worry about, go back to 1982 when stocks were absolutely decimated after a period of high inflation. And the market was so bombed out, you could look at those sort of levels on the Dow in terms of yield return, in terms of valuations, and you knew that if you put money into the market there, you could go to the beach. And as it turned out, you could for almost 20 years and not have to even look at your portfolio. Right now, we don't have that. We're nowhere near those levels now. The New York Stock Exchange Composite has actually given back 7 years of gains already, which is encouraging if you're looking for an entry point. But the Dow and the S&P are nowhere near that. We've just gone back past the Trump inauguration. And I think that the thing that's caught people by surprise here is just the speed of this and the severity of it. We're down, well, we're less, probably 20% now, I think, we're just in bear market territory, which from the levels we were at is nothing. But it happened so fast, and it happened with so many lurid headlines around it, that it's shaken a lot of people up. So everyone, I think emotionally, we all look for stability. We all want someone to put their arm around us and say it's okay and everything's going to be all right. And I think as soon as the markets do that, people are so desperate to hear it and see it on their screens that they believe it a little bit too quickly, I think.
Okay. Thank you for that. And now I want to pivot to gold a little bit, because I know my audience wants to know your opinion. And you had a quote I heard in an interview a couple of weeks ago or a week and a half ago. And you said, if you don't own gold, you should probably buy some. If you do own gold, you should probably buy some more. Now, you and I share a network with a background in precious metals investing, and we know this sentiment, and we know there is consensus with this among the gurus that are usually correct. But a lot of my followers don't have that background. They may be subscribed to our content because, for the investing in the future of medicine and health, or esports, or something in the tech field. And so in all likelihood, they've never owned an ounce of gold in their life. So as simply as you could you explain that thesis a little bit? Why now is the time to consider that as part of your portfolio?
Yeah, I mean, it's a very hard thing to distill into a soundbite. You know, it's 5,000 years of history is what it is. So trying to break that down is difficult unless people are interested in understanding it. And if you're interested in understanding it, you know, it's a rabbit hole you can go down. But once you go down it, you won't come back, because it's you know, gold is money. It's the simple truth of the whole thing, and everything else is just fiat. And what gold does is protect your purchasing power in times of crisis, whether it's deflation, whether it's inflation. You know, the only time gold really underperforms is when you get to levels like we saw in, as I said, in 1982, when stocks, for example, were very, very cheap. They were undervalued, and if you bought your stocks then, you know, they performed extraordinarily well, and gold performed poorly because no one needed gold. There was no crisis. We had a 20-year bull market, so people didn't need gold. In times of crisis, gold is the only really unimpaired asset that's nobody else's liability. If you own physical gold, I don't talk about the ETFs, I think if you own physical gold. And so, you know, people that don't understand gold will look at gold's performance and say, well, look, you know, gold's actually down in the last, you know, month or so. Yeah, it is. But if you look at how many units of the S&P it can buy you, that's increased significantly. You know, gold's purchasing power, if gold's down 5% and the markets are down 30%, well, you know what, you can buy a lot more shares if you exchange your gold for that. And that's the way to think about gold. If you I guess if you want to distill it for people that really don't understand it, if you think of gold as a currency, you know, if you're going on vacation from America to Europe and you look how many euros your dollar will buy you, you have an understanding of whether the euro is cheap or not. Oh, I'm going to have a cheap holiday because I can buy more euros. If you think of gold as a currency, how many dollars does it buy me? How many euros does it buy me? And if you do that, you know, you look around the world, you'll see that right now it buys you more units of just about every currency anywhere in the world, with the exception of the US dollar. You know, you can buy more pound sterling, more Japanese yen, more euros, more Australian dollars, more Canadian dollars than ever before in history. And that's what gold does. That's what gold, it protects your purchasing power. And to me, it's a currency allocation more than anything else.
Right. And to your point about the 5,000 year history, you know, that's really all we have to look at, right? Nothing's certain in this world, but except track records. We can look at things that have occurred, and this is a currency that's survived the rise and fall of every single empire ever, which
exactly
is
right.
a testament.
Exactly right.
Now, you personally, Grant, are you deploying capital at all in this market? Are you cautiously on the sidelines, waiting? Or
oh no, I'm waiting. I'm waiting now. I don't see really any kind of the value that I'm looking for. The only place I see value is in the precious metal mining stocks, because they're so bombed out.
Okay.
And some of the you know, triple leverage ETFs have been playing havoc with what is a very small market. So for me, you know, you've got to be careful not putting all your eggs in one basket, but you know, switching allocations between physical gold and the mining stocks, depending on your risk appetite, depending on where they are, makes sense to me. I think mining stocks are incredibly cheap, and if you look back through periods, look back through the Great Depression and see what the mining stocks did then, they went through the roof. Look back at periods of inflation, you'll see the mining stocks went through the roof, and that, I think, is perhaps the biggest thing that we're likely witnessing. It may not be happening now, but we're certainly in that process of a secular change, and that's from a deflationary to an inflationary environment. And you know, everything that's being done by central banks to mitigate this crisis is inflationary. We have to get through this deflationary shock first, which will take some doing. And during that, as I said, gold will protect your purchasing power. But then if we get inflation, which it's hard to see how we won't, when we have multiple trillions being injected, this time directly into Main Street pockets instead of into the banking system, that's going to change psychology significantly. And with rates reaching zero, the time to take that bet on the other side of rising rates, when we've seen everywhere around the world that the negative interest rates have been repudiated for the most part, pretty much everywhere, you can pretty much assume what your downside is in terms of rates. the upside is unlimited. And we happen to have lived through a period without any inflation. So people don't really remember unless they were alive and old enough in the 1970s for it to have mattered to them. But it was, if you go back and just read some of the newspaper headlines in the 1970s, you'll find extraordinary things. And that's, I think, the big secular change is from a deflationary environment once we get through this to an inflationary environment. And that, again, is a tremendous environment for gold.
Okay, I love that. Thank you. Now, notwithstanding, there are some incredibly traumatic and heartbreaking events that are occurring right now in the world. And I think that unfortunately are probably going to get worse, right? There's pandemonium in the US, but the US is also, got fantastic infrastructure, great medical facilities, the ability to organize law enforcement, all of these things in place. And there's going to be worse scenarios probably outside of countries like that. But there's hopefully, there's always some kind of a silver lining, right? And if I've got one takeaway from, my self-quarantine and my social distancing here in my house, it's how much more I've begun to value community, friendships and family, and the importance of doing more with less. And I think there's a frivolous nature that's being wiped off of a lot of the people that I'm talking to right now as, this sort of great reset is occurring. Are you seeing anything like that in your community or your network?
Yeah, I think there's been talk about a reset for quite some time. In the circles that we move in, it's been talked about as a reset of the financial system that was probably long overdue. But I gave a presentation called Cry Wolf last year, I think it was, or maybe late in 2018, I think, and talked about the change of orders and the return to a gold standard and what that would mean. And for those sort of shift changes to happen, it requires a change in social dynamics as well. And I think that's what we're seeing. And there could be an awful lot of good to come out of this. We're certainly going to see a couple of generations who have grown up in an abundant world, understanding the idea of scarcity, and that's no bad thing whatsoever. In the abundance that we've had in the last several decades, we've had two generations, the millennials and the Gen Zers, that these conditions are completely alien to them. Any kind of restriction is alien to them. Any kind of scarcity is alien to them. And I suspect a lot of them are going to understand the dynamics of over-indebtedness. They're going to realize, wow, I remember when the COVID-19 thing happened, I had no savings. I couldn't pay rent or whatever it is. And those are the sort of things that change mindsets and change behavior. We saw this in the Great Depression. The generation that lived through the Great Depression never took on any debt in their lives. It had to wait a generation until Americans were willing to start borrowing again. So I think there will be some very good things to come out of this from a societal standpoint. And I think you're right. I think people are starting to look inwards and focus on what they have and what's important to them, rather than the next shot. I wonder things like who's going to pay $1,000 for an iPhone the next time Apple release one, when they remember standing in a queue to buy toilet paper. When that's still fresh in the memory. Now, obviously, there are going to be plenty of people who will breeze through this, go out and buy the next iPhone. That's fine. But at the margin, it will make people think differently. And that I don't think that's necessarily a bad thing.
Yeah, I completely agree. It's a glimmer of hope. Okay, look, I thank you for your time. I have one more question for you. I'm gonna put you on the spot because we're all trapped at home, but if we have a Kindle and an internet connection, we can still download a book. So if you had one book recommendation that my audience should read this year, what comes to mind?
Easiest question you've asked me. Read a book. Well, I'll give you two. One is called The Lords of Finance by Liaquat Ahmed, which is a tremendous story that if you read it, it's a historical non-fiction book, all about the central bankers back in the 1920s, 1930s. It's remarkable. There are so many parallels between that period and today. It'll really help people.
Okay.
And the second book I'll give you to read is a book called A Gentleman in Moscow, which was written by a guy called Amor Towles. And that is fiction. and it's one of the most. I mean, I've read a lot of books in my life, and it's one of the most beautifully read books I've ever read. I finished it a few months ago, and I was sitting on the deck reading this thing. I turned the last page, and I immediately went straight back to the beginning and started reading it again. I enjoyed it, so I didn't want it to end. It's a fantastic story.
Amazing. Okay. I want to thank Grant for contributing, and I hope you guys enjoyed that. This next conversation is with the founder of Katusa Research, Marin Katusa, and we get into the details of how he's positioning himself and his fund right now. As you know, the VIX has been hitting all-time highs consecutive days in a row. All of the followers that subscribe to my material are wondering what to do. They're justifiably scared. But after the conversations I've had with you over the last couple of weeks, I get the sense, and I know from watching you over the last year, you've taken a lot of cash off the table, that you've been preparing for this. And this is kind of your zone. Am I right?
Yeah, like this is the pocket I excel in, right? In early February, for all my subscribers, we put a Katusa free ride. And that's a hard thing to do when the markets are rocking. And I had a bunch of indicators why we wrote it in the newsletter. We said cash up. And like I've been saying for over a year, US dollars is going to be the place to be. And I get why so many people in mining, specifically gold bugs, have a hard time with that. But fundamentally, Jay, there's a shortage of US dollars globally. And yes, I'm well aware that the US is just technically printed as though the way people want to think of it. First of all, they're not printing the money, but anyways, it's actually closer to $6 trillion if you incorporate the swap lines, and yet that's still not enough. Okay, so we're approaching close to 20 trillion in a shortage globally. So there's a lot more pressure coming. If you look at the ruble year to date is down about 30% to the US dollar. The Belarus ruble is down 50%. The Canadian dollar is a little over 10% year to date. So we haven't felt it as much yet, but it's going to continue this pattern. And it makes me a very unpopular guy when it comes to the resource sector, but the facts are the facts.
Now, you touched on this in your letter from last weekend. If you could provide some more clarity and explanation for my audience when you talk about the swap lines, because it's up to 6 trillion now. That's US dollars being supplied to other countries, correct?
Well, actually, what happens at a swap line, so let's use some real life examples that I like to use. So let's say Canada or the Australia or the euro, for example. Euro is a great place to go because they're so screwed up right now. The euro is in shortage. The European Central Bank is actually in a shortage of US dollars. So they'll cut a deal with the US Central Bank, the Fed, and they'll have a time frame and an interest rate associated to that. Then what happens is, let's say the French government will cut a deal with the euro and say, okay, we have to now subsidize or do QE and do, collateral loans and lend it to their big companies so they don't go under, subsidize. So let's use the example of Airbus, which is one of the largest corporations in France. So now Airbus has to cut a deal with, the ECB, and they have to do it in euro terms. So they fix the rate in interest rate time frame of the loan. Let's call it 6 months or 12 months. And usually it's going to be 12 months, these swaps. And they got to pay it back. But the problem is these currencies are going to be devaluing relative to the US dollar because everybody needs the US dollar. So let's work through this problem. So there's two fundamental issues. There's the monetary issue, and then there's the geopolitical issue now. How do you think Trump and the Republicans are going to feel that, the US Fed is doing these swap lines to the Europeans to subsidize the Airbus while Boeing is competing for planes in a deflationary market where there's less planes being sold? There's a lot of, Trump's got a massive stick here that he's going to use. So there's that whole angle. On top of that, do you think Airbus is going to be selling more planes? Do you think travel is going to do a quick V recovery, or is it going to be a tough place? Of course, it's going to be a tough place. The logic says, it's going to take a while for things to pick back up. So they're going to have a harder time paying that back. So then it's the classic line of amend, extend, and pretend in debt, right? So there's going to be more issues. So you're going to roll those over. And as there becomes more demand for US dollars, You're going to see continuous market volatility because of these swap lines. And think of it as like a company struggling to make their monthly payments, but that's what's going to happen on a global wide aspect. And that's very deflationary for the economies around the world. And by default, the US is going to benefit from this, but it's going to be painful for all in the near term here. Longer term, it provides a great reset if you know what you're doing. And the alert that you're referring to was, I got my whole team. We came in on Sunday. Yes, I follow the rules of quarantine. I'm the only one coming into the office working. All my other guys are working at their homes. And, I spent the whole Sunday going, this is what we've been waiting for a year. This is why we've been so heavy in cash. Here are our top stocks. And I'm not talking, Jay, about, some junior exploration company that is looking for gold and they're going to do, they're going to be a producer one day. I'm talking about companies that have over $10 billion market cap that pay a yield over 10%. That's what we recommended. And as of today, one of them was up over 100%, paying over 10% yield. So obviously I sent out on Friday, March 20th, a Katusa free ride alert for everybody. And that's the strategy in this market. You got to know what you're doing. And you're seeing the reason why this infrastructure, this pipeline company sold off so heavily was massive funds were in liquidation mode. They had to sell whether they liked it or not. You had all the passive funds in there. The algos were triggering and going wild. And, for 3-4 days there, people were going, what the hell's Marin doing? The stock's $28. How's it ever going to get to 16.5? Well, it went under 16. Our first tranche got purchased. And just 2 days later, it was up over 50%. And since then, it's up another 50%. So that's the strategy I'm using in this market.
And when you're taking positions, you're quite disciplined with this tranche strategy. So for my subscribers who might not know what you're talking about, what does it mean to buy in tranches and why do you do that?
Okay. So let's use a real example that most people know that I'm a very large shareholder of, which is called Equinox. A good friend of mine, Ross Beaty, who's on this webinar with for all your subscribers. He's just a great guy and he's the broken slot machine. So let's use that example. So the first time I did the alert, we had our first price. I never buy, Jay, my whole position at one time, nor does Ross Beaty or Robert Friedland or anyone who's successful in the business. It's not like going to the store and just buying your car and that's it. When it comes to stocks, these companies always need, as they go and buy out another asset or they need further financings, there's always a requirement or a reason, a sell-off in the market or whatever. In Equinox's example, when the first company started actually in our office, the first financing I came in, I said, buy your first tranche. Then when the stock did another merger, I said, buy your second tranche, actually at a lower price. And our average portfolio, and then a third tranche came in about another 6 months later. And our average price in the portfolio is about $6.25 per share Canadian. So it looks great right now that the stock's a little over $10, but I only bought 3 of my 4 tranches. I'm still waiting, and the company's 2.5 years old, and I will get my position. And yes, it's painful. You have to be a very patient investor. Jay, you know me well enough with us being partners in the conference business that my style is a bit different than most. Discipline is absolute key here, and it's frustrating. But by having this tranche system, it also pays in a market like what we're seeing right now, because the US dollar will remain of the currencies the king in the near term, and cash is still king here. Use this opportunity as what I call the great reset to upgrade your portfolio into companies that you always thought were too expensive because of the low cost of capital and all the passive buying, the passive index funds buying these things to stupid valuations. Well, it's come back to where, what Warren Buffett calls fundamental analysis matters. First of all, don't jump in head over water. And this is going to be a super volatile market. We've seen incredible gains, Jay. But, this market is so volatile, we could easily see more pullbacks. And I expect more pullbacks.
Mm-hmm. And do you have an expectation for when the cataclysmic volatility we're seeing on a daily basis eventually, and I'm not saying the recovery begins, but when that starts to calm down?
if I understand your question right, you're basically going like, we're seeing up 10% days on things like Canadian banks and Suncor, and then we're seeing 15% down days. Jay, I don't think that's yet over because the large institutions, the large passive funds, there's still a lot of funds that are out there owning these stocks that are on the brink of liquidation. They're levered. It's not rosy out there. So I still think we're in the midst of this. It feels great to be up huge on a few stocks within a couple of days. And we've had a fantastic 12 months in our portfolio, but I don't think we're anywhere near the woods yet. And I think there's going to be more pain moving forward. Make sure that, if this junior company that you own needs to get financed, who is going to finance it? Who on the street right now can actually finance this stuff, right? So let's look at the sector, right? If you look traditionally at the sector, that's awesome that your kids are in the background. I love that. That's awesome. Hey, man, it's what we got to do in this market. I came down to the office because I just live, a few minutes away in Shaughnessy, but hey, I love it, man. Look, let's really ask ourselves a real question here. Who's going to finance these things? Look how the market's changed. So if you look at a lot of the well-known guys, you compare it to the 2008 global financial crisis, they were, not at their peak, but, guys like John Tognetti, David Elliott, Nash Giwa, a lot of these players at Haywood, Bob Disbrow, David Lyle. I got to know all these guys. Sometimes we're on the same side of the street. Sometimes we're not. Whatever. That's the business. Do you really think they're going to start taking serious risks at, late 60s and early 70s and mid 70s? Mm-hmm. Rick Rule was at his prime in the last game, right? Is he going to start taking the same risks? Maybe, maybe not. But I think he's going to be much more selective now than he was in 08 with who he's spending his time with. He's smart, one of the smartest guys in the street. But what I'm getting at is the capital that was there in 08, 09, 2010, it's changed, right? A lot of the firms that were around in 2008, 9, 10 are gone, right? They didn't last. So now there's fewer pools of capital for the junior game. And the guys that are around, we kind of know a lot of the players, and the one thing, there's patterns, and if they haven't been able to be successful in the last 10 years, what's going to change now in a project? So stay away from the lifestyle executives. Number two, I don't see new capital pouring into the junior game. So what happens there is actually the companies that have the quality assets is actually going to have a lot of tension for the deal, because guys like me or Rick or Van Eck or whatever are going to be bidding on the same assets because we know they're going to work, and we don't want to take the risks on the lower quality assets at this stage of the game. Mm-hmm. So the answer to your question is make sure that you know who's going to finance it, what percentage to the insiders own, what are their cost base, and how viable is the balance sheet of this company, right? Like if they have $1.5 million cash in the bank, I can guarantee you that the management team, the geologists aren't going to go out there and start doing real exploration because they're scared for their jobs. Do you want to own a company that isn't doing anything? Mm-hmm. So you got to really ask yourself, what do you own? Our portfolio has done very well on the junior side of things, and we've kind of pivoted for a couple of reasons, Jay. My own situation with the fund, and personally, you can only allocate so much to the junior game, the disciplined approach. And I also like buying cheap stocks that yield dividend. And where we've been going with the newsletter is if I can buy world-class assets at like what I call Warren Buffett value investing prices and take a Katusa free ride and get a free dividend forever, that's kind of where the game is right now. And that's what I call like the alligator style of playing this game. That's what we're doing. You've seen it yourself through the subscription. But I'm not yet financing a lot of the junior guys because I don't think we're there in the market yet. If you play a rough market, it's literally how you add a zero to your net worth, okay? It's literally how you make 10 times the gains, because this virus, this too shall pass. And I know this sounds crazy, but take away the Trump factor, take away the hate for the US dollar and all these things that you see in the market right now. Mark my words, after this all works out, we're going to touch and exceed the previous highs. And I call it the rise of America because it's so unfathomable to people that this is going to happen. But if you just look at the big macro, take away your feelings, your prejudices to the American market and all these things, it's going to happen. And position yourself and starting to educate yourself in these markets and how to benefit. I wouldn't go into all junior, gold mining stocks or junior uranium stock, but start allocating some of your portfolio to the gambler's portfolio, and then also look at income generating. Some of these. You look at Suncor, what it just went through. The company's not disappearing. It's not going to go bankrupt. Tech is not disappearing. It's not going to go bankrupt. These are the type of things that you have this great opportunity to reset your portfolio.
Okay, now our final conversation today is with the CEO of Wheaton Precious Metals, Randy Smallwood, a battle-tested CEO. Now we get into the details about how Randy is positioning himself as an investor and as a CEO, and what we can expect from Wheaton over the next 12 months. I really enjoyed this. I hope you guys do too. So I wanted to start with this question because you've been through a few of these cycles, right? And I've got financial advisors right now, friends that are calling me saying things like, I have clients calling, telling me to sell everything because the market's going to zero. And, with these cataclysmic sell-offs, it's easy to see how people feel that way. But do you have any advice for investors who are feeling that fear, that extreme fear today?
Well, yeah, it's the problem with that is that if you're selling off everything, it means you're converting it to cash, and cash means you're converting it to US dollars because that's really the only fiat currency that's worth anything in this world. But it's not worth a lot. You sit and look at how much is going to get printed over the next while. I think the phrase helicopter money is probably about as good a descriptor as you can come up with in terms of confidence in the US dollar as a store of value. And so I would strongly recommend that, what we always see in times of crisis is a flee to the most liquid, safe, and stable, say, currency or commodity or whatever. The US dollar is always the first target, but this is the time that gold really shows its ability to sustain value and to carry value, a long-term store, store of value. And so, the recommendations I would have is to beat the curve and to get ahead of everyone, because what we've always seen whenever we see times of crisis is a race to the US dollar and then a gradual step away from the US dollar once they realize how weak that dollar is. And usually the first place people step into is gold. And I think the trick is in times like this is to, get in ahead of the curve.
Yeah, of course. It's that, let's Wayne Gretzky this thing, right? Go where the puck's going to be. And so,
Right.
Exactly. I was wondering about your thoughts on that because, every asset class in the world right now is being sold off as people flood to what you referred to as the first target, being US dollars. Any thoughts on when we might see a decrease in this selling pressure?
Well, it's, I tell you, I don't think that we have any true measure yet of the economic impact of this COVID-19 outbreak, this pandemic. When I see numbers, I don't have a problem envisioning 30 to 40 to 50% unemployment rates. I know just this morning they released some numbers out of the States. So, well over 3 million signed up for unemployment just in the last week, which is 4 times the previous record. And I don't think we've seen the worst of it. I still think that there's companies that are adjusting, companies that are sitting there looking at the balance sheets, trying to figure out where they're going to get their support, what they're going to have to do to survive through this crisis. And another note this morning, some of the airlines are cutting back their flights by 70 to 80%. Their load factors have dropped by 80% over the last few weeks. Those airlines probably haven't adjusted yet either in terms of their staffing and their manpower. So I don't have any problem seeing this getting as bad as 40 to 50% unemployment. So, I still think there's going to be a pretty strong flight to safety, so to speak. And that first place that everyone flies to is the US dollar. So I don't think we're finished seeing the downward pressure, although what we have seen some strength in gold and in silver, the two sort of primary precious metals. We have seen, some bounce back specifically this week. and I'm hoping that that is, as I said, some people I love the Gretzky analogy, going to where the puck is going to be versus where it is. I've seen probably more analyst forecasts come in with no problem envisioning gold over $2,000 by the end of this year, and it just seems to be a real uptick in sort of. It's funny when we've seen gold and silver drop substantially over the last couple of weeks. All of a sudden, there's just been a switch, in everyone all of a sudden being a lot more bullish in terms of where we see gold and silver pricing going. It's funny how we talk about trillions. 10 years ago, we used to talk about billions the way we're talking about trillions of US dollars today. And, just another trillion here, another trillion there. And that is an excellent example of why everyone needs some gold exposure, some precious metals exposure in their portfolio.
Yeah, we really have become desensitized to those numbers because they're substantial and very hard to wrap your mind around a trillion of anything.
Right.
Let alone stim package after stim package. Randy, why do you think the gold price and the silver price have been lagging though? Because typically we see these stimulation packages come out. There's, an immediate correlation to a rise in the metals price, but it hasn't really been the case this time.
Well, but I think what we have is people going through this phase, and I would say there's sort of a natural phase, this flight to safety. We've had sort of the first crowd, and I think it's a continuous phase. And so I still think that we have people trying to get in, like as we have people shifting away from the US dollar and into precious metals, we have more people shifting into US dollars and flight to safety. I have to say, I received an email from a friend of mine who runs an art gallery in New York, who said that she has got some incredible good value on some very, very, very good collectible art. And it's, again, people that are just trying to convert stuff into cash and trying to delever themselves. And so I think that we're going to see that on a continuous basis. We're going to see strength in the US dollar and strength in precious metals. I would hypothesize that eventually that strength will shift more towards the precious metals, but we still have new candidates coming in providing support for that US dollar. It's not everyone doesn't move at the same time. There's definitely a gradational change as we see shift going through. And so that's where I see continued support in the US dollars from other people that are actually having a look at the balance sheets and having a look at their own leverage and deciding, it may be time for me to open up some cash and so on. So I just think we're going to see some continued support like that. But the pressure on gold, the pressure on silver is truly there and very strong. So I don't see any problem with that coming to be.
Okay, now if I were to ask Randy Smallwood, the investor, not just as the CEO of Wheaton, but how are you positioning yourself and your portfolio? And let's just talk near term, like 2020. What are you doing?
I love Wheaton. not that I'm not biased, but I am a huge fan. The streaming model, I truly believe the streaming business model gives investors the best exposure to profitable precious metals production. And so I can be very blunt. My net worth is tied up in Wheaton. I've obviously got a few other stocks that I own, but nothing to the significance of what I've got invested into Wheaton. I've also owned quite a collection of gold, physical gold itself. I've got an investment into a small gold mine, a small placer gold mine that gives me a nice little dividend in nuggets every year that I continue to pile up. And then land, and that's my that's my portfolio is land. If anyone owns in Vancouver, land is always an important part of the portfolio in Vancouver. But that's my portfolio, and it goes back to the strength of the streaming model. I truly believe, my whole objective all the way through in terms of being with Wheaton now for 15 years when we created the company and created the streaming business model was we were looking for a way to give, at the original time, good exposure to profitable silver production. Since 2013, we've expanded that now, and we're more focused on gold than we are silver. But it's profitable precious metals production and delivering that on a consistent basis to our shareholders. And I just think that our risk profile is so much lower than the traditional mining companies, and yet we deliver the same upside, the same exploration potential, the same expansion potential, the same optionality that you get, and better leverage. And so our risk profile is pretty similar to owning bullion or the GLD or anything like that, but we deliver so much more upside. And so I'm a strong believer in Wheaton, obviously, but the streaming business model is, I do think, the best way to invest into the resource industry.
Yeah, well, that's, it's music to investors' ears, right? That's what we want to hear from management teams, that their biggest holding is their company. And that leads me to the reason I really wanted to connect with you this week, Randy, was because the $1 million question is, when this consolidation of US dollars gets reallocated, where's it going to go? My expectation is conservative bets first, which is why I think all of our audience should be looking at Wheaton right now. You are a conservative bet. You've got fixed costs. You do pay a dividend. That dividend just increased, I think, this week. Is that correct?
Yeah, it's our dividend is driven off of, we use 30% of our cash flow currently. We've raised it about a year and a half ago from 20% of our cash flow to 30% of our cash flow. And what we're seeing is as that, we use that as a guideline. And because of our growing production profile, we see an increase in production again this year and over the next 5 years, continued growth, combined with the higher commodity prices that we're seeing in gold and silver and palladium. Palladium, of course, has done very well for us. But having the higher prices in those commodities has just put upward pressure. And so, yeah, our dividend went from 9 cents a share to 10 cents a share, which is just over 10% increase. If we see continued strength in commodity prices, we're going to see upward pressure on that dividend payment again towards the end of this year, depending on how production goes, of course. There is a big question mark around the world in terms of mines, but so far our operations are still... We've only had 2 smaller mines go into suspension mode, and the rest of them are still moving product or producing. So we're in pretty good shape from that perspective. We haven't seen a reason to reduce guidance yet. We're still comfortable that we've got enough capacity within our current operations as it stands today to still meet our guidance for the year. But I urge everyone to stay tuned. This is a very fluid environment and such. But yeah, no, the company's in great shape. And that was reflected in the fact that we were almost forced by our own policies to raise the dividend, but quite happy to do that and deliver that back to our shareholders.
Now, with so much changing on a weekly basis, I think a lot of us, that run companies have thrown our playbooks out and are creating new ones as we go. But can you touch on what's in store for, what are you focused on as the CEO?
I have to say that one of the things you have to understand about our business is that we generate most of our opportunities from the base metal sector, and what we're doing is we're going to the copper mines and buying their byproduct gold and their byproduct silver from those copper mines, or the nickel mines or the lead zinc mines, right? But we're always buying the byproduct, the non-core byproduct precious metals, and that is the opportunity set for us. And if you look at the base metals sector right now, it's hurting. It has not had anywhere near the support that precious metals has had over the last while. And so we saw a real uptick in opportunity set, first in quality and scale, both in quality and scale over the last 6 months. And in fact, we're extremely busy on a couple of large-sized opportunities, deals that would be plus $500 million in scale. So, stuff that would move our needle. Really, stuff that's 300 million and less doesn't move the needle much. They're nice to have, but there's a lot of competition in that space. And whereas we find these larger opportunities, it really narrows down in terms of the competition. So we're busy on that front. Now, one of the challenges that we are having, of course, is the restriction on travel when it comes to due diligence. We're still active on a couple of files where we have satisfied all the site visit criteria and trying to move these opportunities forward and hoping to crystallize something over the next couple of months. But time will tell. But I can tell with new opportunities, we are a company that has prided itself on owning our decisions. We don't rely on consultants. We'll bring in outside experts when we need to, if we have a knowledge gap in terms of what we're doing. But but we have our own internal teams, and in fact, myself as a geological engineer and coming from the corp dev side, I have to taste the dirt. I have to taste the earth at these sites. I have to visit them myself before I justify putting my shareholders' capital into these things. And so until we see some relaxation on the travel, on the ability to do due diligence, it's going to make it tougher to continue to chase those opportunities down. What we'll do is continue advancing through. There is a light at the end of the tunnel. We know that. We just don't know how long the tunnel is. But we'll continue advancing these opportunity sets through the technical due diligence and all the digital, all the data work, and prepare ourselves for probably a pretty aggressive travel schedule once we come out the other side of the tunnel and are freed up. Balance sheets is strong. We've got lots of capacity on that perspective. We've got a $2 billion revolver that we're very happy to use. Again, I don't like cash. I'm not a cash person. So I'm not, if I have cash on my balance sheet, that really should be ounces in the ground. And I'd rather have debt on my balance sheet. And that's the way we've run our company. In the last 5 years, we've invested $6.5 billion into the ground, and we've only had to go to the equity markets for about $1.5 billion of that. The rest of it came from cash flow and from effectively using our revolver, and we will continue to do that. So we've got about 1.1 billion of capacity, plus a couple $100 million in cash on hand. So lots of capacity to act when the opportunity arises. We of course just announced an ATM program, which is just there. We don't plan on using it. To me, dilution to current shareholders is not a good thing. And so if I can effectively use my cash flow and put that back into the ground, and use the revolver to sort of balance the discrepancy between big investments and the continual cash flow that we get every quarter, that's much more effective. In fact, we have gone back and tested if we had not used the revolver, and if we had funded every transaction that we've made over the last 5 years with equity, we would have about 14% more shares issued and outstanding. So that's 14% less value for our existing shareholders. That is very important. That's pretty significant in terms of on a per share basis, which is what we're focused on, delivering value on a per share basis. And so we've got lots of capacity to act. As I said, though, with this pandemic, the travel restrictions that are really limiting our ability to push that. We do have a couple of active files and where we have satisfied the site visit criteria, so we'll hopefully move forward on those things, but we'll see where it winds up.
Yeah, and I think that it's the way I'm seeing it is the pandemic and the travel restrictions and all of this. It was really just the match, right, that set this fire, right, and it will probably be the first thing that is removed. We're still going to deal with the global economy crashing, but COVID-19, isn't the issue, right? It was just the match that set everything on fire, and hopefully that means you can get on an airplane soon and get boots on the ground.
Yeah, well, obviously, safety for everyone is the most important thing, right? And so, we are in a fortunate position where we're probably better suited than most for handling a crisis like this. And in fact, one of the things that I really stress is that all of us should sit back and look at where we are relative to others, and don't forget the charity side, because there's going to be a huge need for it over the next while. We've already modified some of our CSR programs to adapt to the changing needs in this world right now, and in fact have amped up some support for programs that are going to be required over the next while to help Mother Earth get through this crisis.
That's awesome. I love hearing that, Randy. I think it's, if there's ever a silver lining in crises like this, it's that it brings people together, right? You start to appreciate community a little bit more.
I've always been a strong believer that, we will survive through this. It's just human nature that we will, and we will be stronger through this whole process too. There's always lessons to be learned. There's always a silver lining. The trick is being persistent enough to find that silver lining and to maximize what we gain from that.
That's awesome. Okay, guys, that's all I got for you today. I hope you enjoyed it, and I hope you learned something. And if you did, please click subscribe and leave a comment and Let me know who you want to hear from next, and I'll go get them. Thank you.